Big day for the markets after Fed Chairman Jerome Powell said today's 25 basis point cut was not the beginning of a cut cycle. That sent the Dow plunging more than 400 points at the lows. Bob Pisani is live from the New York Stock Exchange to take us through a wild day on Wall Street. Hey, Bob.
It was a lot of fun, but confusing. Now, Powell said his actions today were well telegraphed. And indeed, the 25 basis point cut certainly was well telegraphed. But Powell did not provide the guidance that the market essentially wanted. Traders had levitated themselves into believing that a series of rate cuts were coming. And Powell's press conference started off poorly when he implied the rate cut was a mid-cycle adjustment, which markets took to mean this may be one and done. Not good, since most were expecting 2 or more rate cuts sometime this year. The S&P dropped, as you see here, almost 50 points on that, about 1.5%, but then rallied off the lows as Powell tried to clarify his comments by announcing, quote, "I didn't say it's just one." Well, that just confused things even more. What's this all mean? It highlights that stocks are pricey and there is very little room for missteps. It's tough to be bullish right now, and the S&P is up 20% for the year. Earnings are essentially flat, and there is so little clarity on global growth and tariffs and trade. What has made it easier for the bulls to stay bullish is the direction of interest rates. The markets are becoming more dependent on the belief that dovish central banks will provide a backstop to slower global growth. And it's true. Lower interest rates do help in these situations. The markets, though, were tilted to be an extremely dovish position, and the outcome, Powell essentially struggled to deliver that outcome. The markets bear some of the blame here, Melissa. Nothing in the U.S. economic data or comments from Fed officials of late provided really strong support for a continuing rate cut narrative. UBS said it best after the meeting. Title of their note, "The Data Won." Back to you, Melissa.
Thanks, Bob. Bob Pisani at the New York Stock Exchange. That was an interesting take on Bob's part. Blame the markets for this reaction.
Well, I think the markets for the first 5 months of 2019 were really under the view that as long as the Fed gets out of the way and is not providing a tailwind for us in terms of additional easing, that we're in a better place. I think the blame is purely on the communication of the Fed. We've been particularly critical tonight on this desk, and I don't think there was anything that Powell could have done. Having said all that, we're 90% through second quarter earnings season. We have gotten a relative, I think, upgrade to expectations. We do have a case where macro is mixed at best. You can't tell me that the macro is good in this country. If you look at that Chicago PMI, if you look at these ISM numbers, I mean, we're back at 2016 levels. And in fact, we may be back to where we want to be from a Fed perspective in another 6 months.
Well, the Fed freakout might have taken a chunk out of the markets today, but our next guest is here to sort through the rubble and will tell us what could happen next. Time to go off the charts with Newton Advisors President Mark Newton. Mark, take it away.
Thanks, Melissa. So let's take a look at what S&P did today and really put this entire move into perspective in this volatility. When you take a look at what we did, we pulled back and held exactly where prior April highs were as well as last September. So this area is very important to the broader trend. That's 29.54. A move down under that level means that we're likely going to start at least a 5 to 8% correction, in my view, over the course of August through October. As of now, that has not happened. But we did see some warning signs in recent days. We saw semiconductors down about 6% over the last week. We also saw the VIX up about 15%. Number of new lows on the NYSE also increased and almost doubled from 34 to over 70 as of yesterday. So all this happened before today. So there certainly were a few warning signs of the market slowing a little bit. Brett, the momentum stalling. That in general today was a surprise for a lot of people, and momentum gradually is going to start to turn down, which I think is going to bring about a pullback in the market finally, which a lot of people have been waiting for some time. The dollar, let's take a look at the dollar. We moved really to the highest level we've seen in almost 2 years. So a big spike in the dollar today, and that's coinciding with a lot of weakness in commodities along with emerging markets. That is really something to put into perspective, this huge move in the dollar. Most European markets, obviously, we're seeing those currencies start to sell off a little bit more rapidly. And you think that a dovish tilt by the Fed would maybe cause the dollar to stall. And we've actually seen exactly the opposite. Emerging markets, these actually bore the brunt of what happened today directly because of the dollar. You see EEM breaking down under the key level of prior lows. So that's a negative. We're seeing emerging markets underperform, down about 1.2% for today. The S&P was down about 1%. My thinking is a dollar spike should lead EM to underperform further. I'm thinking we pull back right down to 40, 50, or 40, and that's really something to watch. Dollar moving higher, emerging markets and commodities underperforming. and the start in general of momentum getting a little bit more negative on S&P after a big move and then a stall out.
Mark, I feel like the dollar is sort of the linchpin in terms of, how other places in the markets move. So in terms of how high the dollar could go, what are you seeing? Where's the next resistance point?
I'm thinking that we're actually very close to a level of resistance. I'm starting to get counter-trend signals of exhaustion based on DeMark. We're getting pretty overdone very quickly. So I'm not certain that we go over to 99 and over 100. I'm thinking in the next few weeks, actually, the dollar is going to start to stall out and start to backtrack. And so any sort of pullback would then really coincide maybe with the EM space starting to stabilize. For now, it looks early going into August, so I still think we're going to see a little bit more in the next couple weeks, and we're going to have to wait and see. For now, it's a little bit
premature. Can you tell from the charts at all whether that pullback in the dollar will actually be a pullback or will just be a stall to the upward trend? Yeah,
that's a great point. I mean, until we see it, you really need to see movement down under this prior year's lows. And, the broader trend in the dollar has really been very, very range bound in the last year. So we haven't really seen that kind of evidence that we're going to see, the big pullback in the dollar. For now, it's been a lot stronger than people have anticipated in recent weeks.
All right, Mark, great to see you. Thank you.
Thank you.
Mark Newton of Newton Advisors. Guy, what do you think?
2750 was the low in the S&P on May 27th, recently rallied up to 25 or so. So if you're looking for a level in the S&P where it finds support, I think it comes in the form of about 28.90 or 3% from here, number one. Number two, you mentioned a dollar. I'm glad you did, because if you're looking for a risk out there, don't think that the president isn't convening his inner circle and talking about, are we going to, now's the time to intervene in the dollar. Let's take matters into our own hand, because this dollar's on a runaway train. If that were to happen, it might work in the very short term, but in terms of what it means to the market, I think that could be really problematic.
Well, it's kind of interesting here, right? So the Fed told us that they lowered this insurance rate cut today because of global fears, and Tim just mentioned all the data that we've had that's been coming in weak generally here, U.S. corporate earnings. But think about what's working right now. The S&P's at highs, the dollar's at multi-year highs, bonds just go up. What are they? They're safety trades. I mean, they're literally, we're seeing crowding in the safety trades because the flip side.
Are they safety trades, or is this a rotational trade?
I mean, it's a flight to quality is what's going on. I mean, it's very clear. I mean, so to me,
which is okay to be looking for quality. I think you brought it up earlier.
But then they become very crowded.
Well, maybe so, but I don't know that we're crowded yet. But I would say this. I mean, Lee Cooperman, you brought him up already, so I'll bring him up again.
Sure.
So he talked today, and he basically laid out to all of us. He said, hey, look, he goes, we are not in a bear market. I like what we're seeing, blah, 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 blah. But when asked the question, have you added anything? He said no. So that does say something to what you're talking about right now. Is here's a guy who's involved in the market, he's deep into it, and he's not finding the opportunities that he's looking for. That says a lot. He said he's not adding positions. I took away from that saying, hey, you know what? I got to start getting a few more put protections out there and continue to trade, but less longs in terms of stocks themselves.